All right, guys, we've got a lot of really interesting ground to cover, but before we get into it, maybe we could just do a super quick round of intros. So if you wouldn't mind just doing 30 seconds on yourself and what you both do.
Sure. You want to go first?
Yeah, sure. So I head the ETF trading business at DRW. DRW is a prop trading firm, multi-asset prop trading firm, headquartered in Chicago. They've been around for 25 years, employs about 1,500 people globally. They're better known in the crypto world because of their crypto arm, which is called Cumberland. My specialty is ETF trading, so we've been trading ETFs for a while. We cover all asset classes and trade on all major global venues, equities, fixed income, and more recently, crypto.
Good morning. Thanks, Mike.
GM.
GM. It's nice to see everybody up so early on a Tuesday after all the events last night. My name is Tom. I work at Jane Street. We are a global market-making firm and multi-asset liquidity provider. We started trading in the year 2000. I joined the firm in 2003, and over the course of my career have traded equities, ETFs, commodities, and a bunch of other stuff. But over the last 4 years, I've been helping us build out our digital asset team. It's a growing business for us. We're excited about it, and today we are trading 24/7 out of offices around the world. We trade on the major exchanges, traditional liquidity platforms, and OTC, and we also have a single dealer platform that we use to stream prices to select counterparties in multiple assets.
Excellent. Thanks, guys. So just to contextualize things for the audience, we're going to be talking about this futures-based, or series of futures-based Bitcoin ETFs that just launched. The Bitcoin ETF has been something of a white whale in crypto. I think since 2013, when the Winklevi first applied for an ETF, it's been waiting or a long process, and we finally did get a Bitcoin ETF, but it's a futures-based ETF, critically not a spot-based ETF. So what I want to get your opinions on are, what does that mean when we say futures-based Bitcoin ETF? What are the differences in structure there? And how should we interpret how impactful this will be on the market? So I guess just from a high level, whoever wants to take this, can you just describe what a futures-based ETF is? How does that structure work? And how is it different from a spot-based ETF?
Yeah, so a futures-based ETF is essentially holding futures instead of holding spot. That's the main difference. It's pretty simple in that sense. The impact of this ETF, if I can get to that, is from a regulatory point of view, I think it is quite impactful. I think regulators have finally broken the seal. This is a first real step in that direction, and it certainly can't be the last step that they take. It kind of helps develop the whole ecosystem around ETFs. People can start to add these products to their 401ks. The prime brokers enable their clients to trade these products. Delta One desks at banks are now trading these products as well. So it starts to shape the ecosystem in the form that institutions are used to and familiar with. And in terms of the product, I mean, the first day it traded about almost $1 billion, and in 2 days it amassed an AUM of more than $1 billion. I think it's actually the first day record for an ETF. It's the most volume ever traded, so which is quite substantial. The bid-offer spreads in these products are extremely tight. I market make these products myself. The average bid-offer spread is like 1 basis point. And the margins for us as market makers are super thin. It's like the margins I make on these products is no more than margins I make on any other commodity or VIX ETF, let's say, which is also holding futures. So overall, I think it's pretty good for the investor community.
So just to, from the brain of a 5-year-old, because I have the brain of a 5-year-old, you all can't tell. Can you describe, I mean, there is a couple of hangups or challenges with the futures-based structure, right? Specifically, there are roll costs, right? And there's an idea that retail investors, especially if they're buying this, might not really understand what those are. So maybe you could just describe roll costs, what those are, and whether or not, how do you think the retail community is interacting with this product, basically? Is it a good product for retail?
Okay. So certainly, and as Abby was saying, the big difference between a futures-based and a spot-based ETF is simply just what they hold in their basket. And one of the complications with futures is this fact that futures have an expiration date. Like you can't just put futures in your basket and then hold it out to perpetuity. So essentially, this concept of roll cost is mostly in the fact that at some point you have to roll your futures from one expiration to another before, in some kind of optimal liquidity window. But because what you're doing is you're actually, let's say, simplistically, you're selling the front month future and buying like a second or a back month future. You're paying execution costs on both legs of those trades. In addition to that, you're paying some element of whatever the forward curve implies. And so, right now the futures are in contango. What that means is that, the price of the forward curve is upward sloping. And in rational markets, you can imagine that the price of a future kind of reflects the cost of storing and financing spot positions out until expiration. But obviously there's some additional volatility in the Bitcoin forward yield curve that adds some element of additional costs. Because when you're selling the front month, you're buying the back month kind of at a higher price. And so it introduces some additional cost there.
So, I want to transition to the impact of what this ETF means, or these series of ETFs mean. So I think for a long time, if the Bitcoin ETF was the white whale of crypto, then regulation has kind of been the final boss, so to speak, in that obviously we know that the space is going to be regulated at some point, and there's a worry certainly from potential investors or industry participants that we could get something that looks like really draconian regulation, and even if that doesn't kill the industry, it might put a really solid dent in it for a number of years. So we didn't get the spot-based ETF that a lot of industry participants wanted. We did get a futures-based ETF. In your opinion, what can we interpret? Is this a blessing from the regulators? Is this a cautious first step? How should market participants interpret whether or not this is a real blessing, I guess specifically from US regulators?
I think it is a stamp of approval for this industry and for this asset class, but it is also a cautious first step. You kind of did expect a futures-based ETF to come to market first before a physical Bitcoin ETF. I also do expect an Ethereum futures-backed ETF is likely before we see a physical Bitcoin ETF. And that's just because I think the regulators would like an additional layer of oversight. So in the case of a futures-backed ETF, they have CFTC and the CME SROs who provide that additional layer of oversight, which they don't have yet in the physical Bitcoin ETF space. Over time, as the ecosystem grows and matures, and I think it's inevitable that we do see a physical Bitcoin ETF. When that's going to happen is a speculation. I can only say that it's not going to happen this year.
Thomas, anything to add?
Yeah, I do think that kind of aside from the regulators, like why should people care about whether a product is futures or spot backed? And we've seen a lot of criticism that comes from the crypto space, and it's echoed, by the way, in the traditional circles about kind of the limitations of futures-backed ETFs. One is kind of reduces to this idea that the beta of futures to spot isn't one. Like because of the volatility in the forward yield curve, if Bitcoin moves up $1, you might see the futures move up 95 cents or $1.05 in a way that isn't always predictable. There's obviously the roll cost question, and there's also, position limits have forced issuers to adapt some additional complexity or incorporate additional complexity into their product structures. But I think it is maybe useful to take a step back and think about why certain investors, especially institutions, might care about or find comfort in the fact that these products are backed by regulated futures. For one big thing is that because these are cash-settled derivatives, they're safer from an asset security standpoint because the underlyings can't be hacked or stolen. Because they trade on the CME, it's more resistant to things like flash crashes and exchange outages. And so if we take like the flash crash example, for instance, there was one a few weeks ago on Binance US, and I'm not picking on Binance, like this happened on multiple exchanges, but where the price of Bitcoin dropped to 8,200. If this had happened during an ETF determination window, then it would have caused even more pain because all the holders of the ETF would have been forced to mark their positions to market. And that resultant drop in portfolio value would have triggered huge margin calls. And we've seen this vulnerability, like this reliance on single venue pricing causing problems in the DeFi world. I think in large part it explains what happened in the cream finance attack. So the way the CME and the Bitcoin reference rate manages it, it's an aggregation of multiple exchange feeds. It's time sliced over long periods of time. And it has a facility to throw out outliers, so any single kind of dislocation can be managed within the price. And from an exchange outage standpoint, like the CME is just less susceptible to exchange outages and when things get really volatile and busy. Also, when things get volatile, there are circuit breakers on the CME that prevent the price from moving too far too fast. And the CME also lacks the liquidation mechanism that is kind of largely responsible for some of the cascading price action that you see on crypto exchanges. So, it's pros and cons. And having a futures-backed ETF, I think, is certainly a very, very useful tool for investors to have in their toolbox.
Absolutely. So listening to you talk, something actually just occurred to me. I'm going to try to think out loud, which is always dangerous for me, but especially this early in the morning too. But what are some of the complications of having a futures-based ETF on a spot product that trades 24/7 in a global way? I'm even just trying to think. So, I mean, CME is open, from my understanding, right, from 9 till 4 or something like that. How is pricing working, right? Because the exchange will shut down after a period of time, but Bitcoin is continuing to trade. So how does that pricing work, and what are some of the other complications about trying to basically limit this product to a certain period of time to a specific subset of investors when the spot product actually has this global 24/7 type nature?
So the CME futures are actually open for almost 22 hours of the 24 hours. Market makers like us, like Jane, probably can also provide liquidity off-screen in the ETF. So they're not really limited to the trading hours of the exchange. Also, the exchanges have a pre-market and a post-market session. It doesn't trade a lot during that session, but it's the same market makers providing the same liquidity. So you have ways to trade outside the regular trading hours.
Got it. That's why I don't think out loud. Really. So in crypto, we love to refer to institutions as this big homogenous group, right? When in reality, it's much more nuanced than that. There are different sorts and types of institutions. But I'm going to call on you both to speak for the institutions. I mean, what does demand kind of feel like for this product in general? Do you think that this is going to onboard the next wave of institutional investors? Like, what's the impact in terms of bringing more capital from kind of the institutional marketplace into the crypto one?
Sure, I'll start, and you can follow up. Well, from our view, ETFs of any kind, whether they're spot or futures or whatever, are really useful because from our perspective, it helps lower the barrier of entry for some institutions. And for others, it kind of helps them overcome some of the limitations that might have restricted their ability to interact with the space in the past. And so if we take, for example, there are some institutions that have equities-only mandates. So you can only invest in products that are listed on equities exchanges. Some institutions might need adjustments to regulatory licenses in order to trade spot crypto. Their tax or accounting frameworks may not be able to handle entirely new asset classes. Some institutions only restrict their portfolio managers from trading or investing in products that are on a pre-approved compliance whitelist. And it is easier to get an ETF ticker put up for compliance review than it is to, say, add Bitcoin. ETFs plug into the institutional infrastructure in a way that makes asset allocation a little bit more conceivable. And it's not just asset allocators, by the way. Crypto ETFs also allow service providers to kind of get their minds around integrating digital assets. Some examples of this are like exchange clearing members. They're the ones who fund the huge default pools at some of these exchanges. Or execution brokers, instead of having to try to plug into this like fragmented crypto space, they can just add an ETF to their product list for clients. And so ETFs kind of help institutions overcome the philosophical barrier of holding or trading a crypto product, which makes the ecosystem open up. And by the way, like at Jane Street, we have these conversations with traditional players more or less constantly. And our hope is that we can add a little bit of value to the overall discussion if we're a little bit more public about our interactions with the crypto space. You know, our historical role as liquidity providers to assist in the formation of fair, orderly, and efficient markets needs to adapt to the crypto ecosystem because the market is still developing, like in multi-dimensional ways. You know, from our perspective, facilitating the two-way flow of information and hopefully eventually capital between the traditional financial space and the growing crypto ecosystem is a very natural fit for us. You know, we believe that we can we can help educate traditional institutions about, you know, how to trade, find liquidity, manage risk in the crypto system. And conversely, you know, we want to learn from the crypto ecosystem about the solutions you guys are building, and maybe share some of our discussion, some of our experience with how the traditional financial system tries to solve the same problems that you guys are solving, and ultimately to build a better market for all market participants. And I know we're not alone. Like, for those of you who aren't aware, DRW was absolutely instrumental in helping building the early foundations for this, and we owe them all a huge debt of gratitude. And Blockworks, thank you guys for your role in facilitating these conversations as well. So, yeah, from our perspective, ETFs of any kind is a very, very useful gateway between those two worlds.
Can I ask both of you guys something? Actually, I'm just thinking as you're talking here. This doesn't have to do with the ETF, so I'm throwing you a curveball right at the end. But very few people understand much about financial plumbing in general. And the group of people that understand financial plumbing in crypto versus traditional markets is even fewer. And as someone who's tried to understand financial plumbing in both spaces, I know it's very difficult to do. And one narrative or thing that I've kind of heard from folks in more traditional capital markets that are coming into crypto is people in crypto are kind of reinventing concepts that already exist in traditional financial markets. To what degree do you think that's true? To what degree are we just re-architecting or reinventing things that already exist? And to what degree do you think things are totally novel, new, emergent, couldn't exist in the existing structure?
Was that?
I'm glad you get to answer that one.
So I think you're right. There's a lot of reinvention that probably is going on there. For a start, in the TradFi world, the concept of a prime broker is a given. So there is like one prime broker where you'll be able to house all your positions, clear all your positions, get margin offsets. They'll do all the post-trade settlements for you, handle all the corporate actions. Well, you don't really have corporate actions in crypto though, but if you have a fork, for example, that could be the equivalent of a corporate action. So the prime brokers would handle all of that. They would handle all the tax implications of your trading as well. And all you would have to do, and what that does is it makes your capital very efficient as well when you're trading. That in crypto land doesn't quite exist as a full solution. There are multiple vendors that provide parts of that solution, but there's not like a one-stop shop.
Yeah, and just to add to what Abby said, like if you think about all of the different ways that people are trying to essentially solve the problem of capital inefficiency, like you have a central pool of capital, it's kind of locked up by venue. How do you make sure that you can kind of use that capital to trade across multiple venues and settle and everything else? You know, a lot of the solutions that we're seeing do look like variations on, you know, like some just focus on settlement, which looks a lot like CLS, which is used in the FX world to kind of compress large FX trades. Intercustodial settlement, that's something that looks like a lot like the London Precious Metals Clearing Network, which is used in physical metals, where they just kind of net down exposures at the end of the day. There are some, you know, like some of the DeFi pools, they're talking about like fully KYC DeFi pools. That looks a lot like an FX ECN, where there's like a credit intermediary that sits between the different parties. So in a lot of ways, like there is unquestionably some very, very valuable innovation that is happening in the space. But you know, there are also some that I think that, you know, people like Abby, people like myself, we could you can have conversations with us, and we can kind of talk you through like why these things work in the traditional space, and why some of these things could stand to be improved.
Awesome. Well, guys, thanks for humoring me, especially that last question. This was a pleasure. Unfortunately, it's all the time we have, but thank you so much for doing this. Guys, give them a big round of applause.